Revenue growth in a challenging environment defined Universal Robina's first half of 2026. At first glance, the numbers show modest progress. Consolidated revenue reached 89.34 billion pesos, a 4% increase. But beneath that headline lies a story shaped by currency movements and strategic pricing. The weakening Philippine peso became an unlikely ally, especially in overseas operations. For international branded foods, reported revenue climbed 7%, translating foreign sales into a stronger peso value. In dollar terms, however, sales were stable. The exchange rate flipped what could have been a flat result into a solid gain. Robust markets in Malaysia and a recovering Vietnam offset slower performance elsewhere. International operating earnings outpaced revenue with a 12% rise, signaling disciplined execution beyond raw sales numbers. Back home, domestic branded food sales advanced by 6.3%, mostly driven by price adjustments. The standout performer was animal nutrition and health, where volume growth powered a 21.3% revenue increase. Flour sales grew decisively, while Sariaya facility expansion added to the momentum. Yet, not all segments shared in the progress. Commodities such as sugar and renewables dragged, shrinking segment revenue and operating income. This is a clear display of a company moving at different speeds across its portfolio. Profitability painted a more nuanced picture. Gross profit margins widened, but operating income remained nearly flat. Higher costs in advertising, promotions, and freight absorbed nearly all the incremental gross profit, narrowing margins and highlighting the cost of growth in today's market. Net income did rise by 10.1%, thanks to lower finance costs and reduced impairments. However, core net income, reflecting recurring performance, advanced just 2.9%, reinforcing the nature of incremental gains in a competitive landscape. The most compelling shift appeared in cash generation. Operating cash flow more than doubled to 9.3 billion pesos, but the real driver was improved working capital management. Accounts payable cycles normalized, trade obligations were managed more efficiently, and increased use of short-term trade financing lifted cash flow. Receivable collections remained strong, though inventory built up, offering future potential but also raising questions about sustainability. The surge in cash reflects disciplined financial management, yet much is tied to timing and working capital mechanics rather than operating profit leaps. Capital investments continued, and Universal Robina rewarded shareholders with rising dividends. This year's dividend payout reached 4.40 pesos per share, a 4.8% increase, underpinning the company's role as a core cash engine for its parent, JG Summit Holdings. It remains a critical dividend contributor, second only to Meralco within the group. For investors and analysts, Universal Robina's report delivers a balanced message: resilience in revenue and cash flow despite uneven profitability and commodity headwinds. Strategic levers, pricing, currency translation, disciplined working capital, converted modest growth into substantial cash generation. Whether this performance endures will depend on future inventory sales and the normalization of payables. But for now, the company's financial management inspires measured confidence amid industry complexity.